If you've ever opened a stock app and immediately felt behind, you're not alone. The world of investing has a way of making normal people feel like they missed a class everyone else attended. Prices move fast, headlines change daily, and everyone online seems to know exactly what they're doing. Here's the uncomfortable part. Most of that confidence is fake. The truth is, most investors don't outperform the market. Many don't even keep up with inflation, and it's not because they're lazy or unintelligent. It's because they're playing a game they don't understand. The most successful investor in history didn't win by predicting trends or chasing what was popular. He won by doing something slow, methodical, and surprisingly simple. His name is Warren Buffett, and once you understand how he actually thinks about investing, everything starts to make sense. Most people start investing the same way. They decide they should do something with their money, open an app, and immediately get overwhelmed. Stocks are flying up and down. News alerts talk about crashes one day and massive opportunities the next. It feels urgent, chaotic, and emotional. So people react. They buy because something is going up. They sell because something is going down. They jump from stock to stock, hoping this time they'll catch the right one. This isn't stupidity, it's human nature. But it's also exactly how wealth doesn't get built. When you invest this way, you're not making decisions. You're responding to noise. And noise is expensive. Value investing exists to remove that noise entirely. At its core, value investing is about thinking like a business owner instead of a trader. When you buy a stock, you're buying a small piece of a real company. That company sells products or services, earns money, pays expenses, and hopefully grows over time. Value investors focus on that reality, not the flashing numbers on a screen. Imagine someone offered to sell you a local business. You wouldn't buy it just because the asking price went up yesterday. You'd want to know if it makes money, if customers keep coming back, and if it's likely to still exist 10 or 20 years from now. Stocks work the same way. The difference is that the market constantly shouts opinions at you, trying to convince you to care about price instead of value. One of the most important ideas in investing is that price and value are not the same thing. Price is what someone is willing to pay today. Value is what the business is actually worth based on what it can earn over time. Markets are emotional. They get excited. They panic. They overreact to news. Value investors use that behavior to their advantage. In the early 2000s, during the dot-com crash, Amazon lost more than 90% of its stock price. To most people, that looked like failure. But some investors looked past the price and asked a different question. They looked at the business itself. Customers were still buying. Revenue was still growing. The long-term story hadn't changed. Those investors weren't predicting the future. They were simply separating price from value. Value investing revolves around a few foundational ideas, but they're easier to understand than they sound. The first is intrinsic value. This is simply an estimate of what a business is truly worth based on its ability to generate money in the future. You don't need advanced math to grasp the concept. If a company consistently earns money, has loyal customers, and operates in a stable industry, it likely has real value beyond short-term price swings. This is why companies like Coca-Cola have been attractive to value investors for decades. People don't stop buying their products because the market is nervous. The business keeps functioning regardless of headlines. The second idea is the margin of safety. Value investors don't try to buy at the exact moment a stock is fairly priced. They wait. They buy when the price is clearly below what they believe the business is worth. That gap creates protection. It allows room for mistakes, bad news, or unexpected downturns without permanently damaging the investment. This principle was emphasized by Benjamin Graham, who taught Buffett to always leave room for error. The third idea is long-term thinking. This is where most people struggle. Value investing doesn't feel exciting early on. There are no constant wins, no daily dopamine hits. But time is doing the heavy lifting in the background. Compounding doesn't look impressive at first, but over years and decades, it becomes unstoppable. Buffett has often said that the stock market rewards patience. That isn't a slogan, but it's an observation based on decades of experience. If you're new to investing, the goal isn't to analyze hundreds of companies or chase every opportunity that shows up on your screen. It's to build the right mindset first. Before strategies and numbers, you need a way of thinking. Start with businesses you already understand, brands you recognize, services you use regularly without thinking about it. These companies are familiar for a reason. They've already proven they can attract customers and operate at scale. Even more important, look for businesses that have survived multiple economic cycles. Longevity is a signal that a company can adapt, endure downturns, and continue operating when conditions aren't perfect. When you look at a stock, try to think less about what it might do this month and more about what the business might look like 10 years from now. Short-term price movements are often driven by noise, emotion, and headlines. Long-term results are driven by the strength of the underlying business. Ask yourself whether the company still makes sense, whether its product or service will still be relevant, and whether it can continue generating value over time, not whether the chart looks good today. You don't need to trade frequently. You don't need constant action to be a good investor. In fact, doing less is often the advantage. Many investors hurt themselves by reacting too often. Value investing isn't about speed or excitement. It's about discipline, patience, and letting time do the work. Here's the shift that changes everything. Investing isn't about being clever, predicting the next big winner, or constantly trying to outsmart the market. It's about being consistent. It's about doing a few simple things well and repeating them over long periods of time. Most successful investors don't win by making brilliant moves. They win by avoiding obvious mistakes that quietly erode wealth. Overtrading, chasing excitement, or letting emotions dictate decisions. Consistency means staying rational when others panic and staying patient when others get greedy. It means resisting the urge to react to every headline or price swing and refusing to overpay just because something feels exciting in the moment. Excitement is expensive. Discipline is not. Once you start thinking like an owner instead of a speculator, investing begins to feel different. The noise fades into the background. Decisions slow down and become more deliberate. You stop reacting and start evaluating businesses on what actually matters: durability, profitability, and long-term relevance. The process becomes calmer, clearer, and far less stressful. And over time, that clarity compounds just as powerfully as your money does. While others burn energy chasing short-term wins, you're quietly building something durable, letting patience, discipline, and time do the heavy lifting. Warren Buffett's success wasn't built on secrets. It was built on patience, discipline, and respect for value. If this helped investing finally make sense, let me know in the comments. This isn't about getting rich fast, it's about not staying broke slowly. Hope you enjoyed this video and found it informative. Please subscribe for more investing content. That way you can keep building your wealth the right way.